Hi everyone, it's Caitlin, and welcome back to Your Financial Journey. So, if you guys watch the news, or even just talk with your financially minded family or friends, you've probably heard references to the stock market. Is the stock market going up? Is it going down? When we talk about the stock market and its performance, we aren't really looking at every single stock out there. Instead, investors track the stock market through indices, such as the S&P 500. The S&P 500 is often talked about, and because of its ability to efficiently track the US stock market, it's important to understand how it works and what it is. So, today, let's dive deeper into the S&P 500. What is the S&P 500? What is its history? And what are its uses? Let's go! What is the S&P 500? Well, the S&P 500, which stands for the Standard & Poor's 500, is an index. Indices are essentially just a collection of some sort of asset that is used to track the performance of a wider sector or market. So, in the case of the S&P 500, it's a collection of stocks used to track the performance of 500 leading companies in the US stock market. The S&P 500 is a capitalization-weighted, or cap-weighted, index, which means that the companies inside it are weighted depending on their total market value. More valuable companies have a greater impact on the S&P 500 than smaller companies, so the S&P 500 can accurately reflect the market. Specifically, it is based on public float market capitalization, with public float meaning how much of a company's shares is available to the public. As I said, the S&P 500 contains the 500 leading companies in the US stock market. For a company to be included in the S&P 500, it must fulfill certain requirements. The company must be located in the U.S., have a market cap of at least $8.2 billion, have highly liquid shares with at least 50% of its outstanding shares available for public trading, and its earnings in the most recent quarter, as well as the sum of its earnings in the previous 4 quarters, must be positive. At the time of this taping, the top-weighted company in the S&P 500 is NVIDIA, with a weight of 7.01%. Second is Apple at 6.33%, and third is Microsoft with 4.18%. Other than these 3 companies, other leading companies in the S&P 500 include Amazon, Alphabet Inc., the parent holding company of Google, Tesla, Meta, and more. The top 10 companies of the S&P 500 actually account for over 30% of the entire S&P 500, meaning that their performance has a disproportionate impact on the index. While the S&P 500 contains 500 companies, it actually includes 503 stocks, not 500, as 3 companies issued 2 different share classes as stocks. So, now that we have a good overview of what the S&P 500 is, let's talk a bit about how the S&P 500 came to be where it is today. What is the history of the S&P 500? You could say that the S&P 500 as an index has existed since the 1920s, though it really started at first as the Standard 90 rather than the 500. At that time, the index was a collection of 90 stocks from 50 industrial companies, 20 railroads, and 20 utilities. When the Standard 90 was introduced, it was the broadest daily index calculated in the US. It was created by the Standard Statistics Company, which later merged with Poor's Publishing in 1941. So, as you can see, the Standard & Poor's, or S&P. The S&P 500, as we know it today, was officially created on February 27, 1957, at the Lawyers Club in New York by Lou Shellback, who is considered the father of the S&P 500. This original S&P 500 index included 425 industrial stocks, 15 rail stocks, and 60 utility stocks. This early S&P 500 was powered by a new electronic calculation method from Melpar Inc., which performed index calculations much more efficiently than previously. Though they could have tracked every stock on the New York Stock Exchange, they settled on a group of 500 stocks that represented the market. At the time, the S&P 500 covered around 90% of the market value of the New York Stock Exchange's common stocks. The S&P 500 was unique because it could be calculated and distributed on an hourly basis. The index was revised in 1976, and the makeup changed to 400 industrialists, 40 utilities, 40 financials, and 20 transports. The introduction of financial stocks, which reflected the changing American economy, resulted in the creation of a fixed 400 40-40-20 model, which required the 500 stocks to specifically be split up in this way by industry. It also changed rail stocks to the broader transport stocks, which was another way to make the S&P 500 more reflective of the American economy. This 400 40-40-20 model lasted for 12 years. But in 1988, the model was abandoned, and it was replaced by the system we have today, where industry weights depend on the broader market and are not strictly fixed in a certain ratio. This change was made thanks to the fast growth of certain industries like technology and healthcare, which did not fit within the strict model in place before 1988. This leaves us with the modern industry distribution. With 11 different main sectors, at the time of this taping in July 2026, technology is the largest industry with around 35% of the total market capitalization, and finance and communications come in second and third, at 12% and 11% respectively, which is quite a change from the dominance of industrialist and rail stocks from the past. So today, the S&P 500 has grown to become one of the most followed U.S. stock indices. When people talk about the stock market, they are often referring to the S&P 500 because it is made up of many large companies and reflects the overall stock market, with the S&P 500 representing around 80% of the total value of the U.S. stock market today. Now, let's see how the S&P 500 is used in real life. What are the uses of the S&P 500? The S&P 500 is considered one of the best benchmarks for tracking the health of the overall economy, from boom to bust and everything in between. Investors use the S&P 500 in this way for many reasons. Firstly, as I mentioned, the S&P 500 is a diversified index that represents 11 different key sectors of the U.S., meaning that it broadly reflects the makeup of the U.S. economy. The S&P 500 also has historically good return rates, which we will talk about in more detail in just a moment. Since it's an index, it cannot be directly invested in. However, you can invest in index funds based on the index, such as mutual funds or exchange-traded funds, also known as ETFs. These funds then buy the stocks that make up the S&P 500 in the same proportions as the index itself. S&P 500 index funds not only rank among the largest funds, but also claim the top spots for ETFs. The average return of the S&P 500 varies year by year, and no one can really predict with any certainty where exactly it will go in the future. However, we can always look at the past, but keep in mind that past performance is no guarantee of future results or outcomes or returns. So, with that in mind, the overall average return rate since its inception in 1957 is about 10% per year. This is a pretty attractive long-term return rate that is higher than bonds or actively managed funds. We can even look at more recent performances of the S&P 500 through its returns. For instance, from the beginning of 2021 to the end of 2025, the S&P 500 returned about 16% on an annualized basis, which is slightly higher than the long-term average of 10%. This indicates that the past 5 years have been very good for the stock market. However, this is a limited time frame, and a longer time frame skews closer to the average of 10%, as I just mentioned. For example, the average return over the past 30 years was 10.4%, and the average return over the past 40 years was 11.5%. But it's not all growth. From 1928 to 2026, the S&P 500 has had negative return years as well, the worst of which was in 1931 during the Great Depression, when it dropped by negative 43.84%. The financial crisis of 2008 also saw low returns at negative 36.55%. COVID also saw declining markets, with negative 18.04% in 2022. On the brighter side, the best return rates of the S&P 500 have gone into double digits, such as a return of 37.20% in 1995. But if you are a consistent long-term investor who dollar cost averages into the market, for example, it may make sense to work with a longer-term average of about 10%. It is also important to note that the S&P 500 return numbers that we've been discussing are before inflation. you will need to deduct inflation of around 2.5 to 3.5% if you want to get what economists call the real returns from your investment. So, for example, the average real return rate adjusted for inflation is actually closer to 6.5 or 7.5% than 10%. Percentages are nice to hear, but let's make it more concrete with some sample numbers. Assuming the long-term 10% return rate from before, if you invested $1,000 in the S&P 500 from your first summer job, that would grow to a bit more than $117,000 when you might retire after 50 years. Under the same assumptions, if you invested $5,000 in the S&P 500 and waited 50 years, you would end up with nearly $587,000. This amount of money can greatly help you in the long run, for example, when you retire. So, the S&P 500 isn't just useful in tracking the stock market. It can help you grow your wealth as well if you start saving and investing early. So, what do you think about the S&P 500? Did you know about its history, or were you surprised about it? And maybe you already own a few shares in an S&P 500 fund like many of us do. Drop a comment and let us know. And make sure to like and subscribe if you learned something new or found some of our information helpful. And check out this video here from my sister Ava on index funds if you want to learn more about investing and how to grow your wealth. Thanks for watching, and we'll see you again next time.